experts to put together tonight's Mansion House reforms. I'm also immensely grateful to Sir John Simons and Sir Steve Webb for their advice on how to construct this package. And I'm also very grateful to Gwyneth Nurse and her brilliant team at the Treasury. Gwyneth is, of course, the real Chancellor, as we official Chancellors come and go. Tonight I lay out the direction of travel. Sometimes consultations will be necessary, but all final decisions will be made ahead of the autumn statement later this year. And as we make those decisions, I'll be guided by 3 golden rules. Firstly, everything we do will seek to secure the best possible outcomes for pension savers, with any changes to investment structures putting their needs first and foremost. Secondly, we'll always prioritise a strong and diversified gilt market. It will be an evolutionary, not revolutionary change to our pensions market. Those who invest in our gilts are helping to fund vital public services, and any changes must recognise the important role they play. The third golden rule is that the decisions we take must always strengthen the UK's competitive position as a leading financial centre able to fund, through the wealth it creates, our precious public services. I start with defined contribution pension schemes, which in the UK now invest under 1% in unlisted equity, compared to between 5 and 6% in Australia. Today, I'm pleased to announce that the Lord Mayor and I joined the CEOs of many of our largest DC pension schemes, namely Aviva, Scottish Widows, L&G, Egon, Phoenix, Nest, Smart, Pension, M&G and Mercer, for the formal signing of the Mansion House Compact. The Compact, which is a great personal triumph for the Lord Mayor, commits these DC funds, which represent about 2/3 the UK's entire DC workplace market, to the objective of allocating at least 5% of their default funds to unlisted equities by 2030. If the rest of the UK's DC market follows suit, this could unlock up to £50 billion of investment into high-growth companies by that time. Secondly, we know funds can only optimise returns from a balanced portfolio if they have the scale to do so. We'll therefore facilitate a programme of DC consolidation to ensure that funds are able to maintain a diverse portfolio of bonds, equity and unlisted assets and deliver the best possible returns for savers. Tomorrow, the Department for Work and Pensions will publish its joint consultation response with the pensions regulator and the FCA on the value for money framework, clarifying that investment decisions should be made on the basis of long-term returns and not simply cost. Pension schemes which are not achieving the best possible outcome for their members will face being wound up by the pensions regulator. We'll also set out a roadmap to encourage collective DC funds, a new type of pension fund which we believe holds great promise for the future. Third, we need to ensure that all schemes have access to a wide range of investment vehicles that enable them to invest quickly and effectively in unlisted high-growth companies. We've launched the LIFTS competition and we'll consider closely the bids that have already started to come in for up to £250 million of government support. Alongside that, we'll explore the case for government to play a greater role in establishing investment vehicles, building on the skills and expertise of the British Business Bank's commercial arm, which has helped to mobilise £15 billion of capital into over 20,000 companies. Ahead of the autumn statement, we will test options to open those investment opportunities in high-growth companies to pension funds as a way of crowding in more investment. I now move on to defined benefit schemes, which number over 5,000 and operate under a different regulatory regime. Their landscape is also too fragmented. I recognise the important role played by insurers offering buyout schemes which will continue to be an essential part of the way we improve security for pension members in this market. But in addition, we will set out plans on introducing a permanent super fund regulatory regime to provide sponsoring employers and trustees with a new scaled-up way of managing DB liabilities. Having engaged closely with a range of experts, we'll launch a call for evidence tomorrow on the role of the PPF and the part DB schemes play in productive investment, whilst always being mindful of the second golden rule to protect the sound functioning and effectiveness of the gilt market. Fifth, we'll look at the culture of investment decisions and improve the understanding of pension trustees' fiduciary duty across both DB and DC schemes. DWP and HMT will jointly launch a call for evidence to explore how we can overcome barriers and ensure a focus on good saver outcomes. And finally, government must lead by example, so we'll consult on accelerating the consolidation of local government pension scheme assets with a deadline of March 2025 for all LGPS funds to transfer their assets into local government pension pools and ensure greater transparency on investments. To make sure we are delivering the maximum benefits of scale, we'll invite views on barriers to achieving better investment returns across the LGPS, as well as setting a direction that each asset pool should exceed £50 billion of assets. We'll also consult on an ambition to double the existing local government pension scheme allocations in private equity to 10%, which could unlock a further £25 billion by 2030. Today's announcements could have a real and significant impact on people across the country. For an average earner who starts saving at 18, these measures could increase the size of their pension pot by 12% over their career. That's worth £1,000 more a year in retirement. At the same time, this package has the potential to unlock an additional £75 billion of financing for growth by 2030, finally addressing the shortage of scale-up capital holding back so many of our most promising companies. Increasing borrowing through £28 billion a year of unfunded spending commitments, as some are suggesting, would entrench inflation and push up interest rates. These reforms, conversely, unlock capital from the private sector, delivering growth not by subsidy, but by increasing support for entrepreneurs and investors who take risks to create long-term value. I now move on to listings. The UK has the largest stock market in Europe, and in 2021 attracted the most global IPOs of any stock market outside the US. But between 1997 and 2019, there was a 44% decline in the number of domestic listed companies in the UK, part of a wider trend across Western markets, with the US and France seeing even steeper falls. I want the world's fastest growing companies to grow and list right here, making LSE not just Europe's NASDAQ, but much more. As David Schwimmer and Julia Hoggett say, we want it to be the global capital for capital. So today we're publishing draft legislation on prospectus reforms, delivering another milestone of Lord Hill's UK listing review. This will create a more effective regime than its EU predecessor, giving companies the flexibility to raise larger sums from investors more quickly. The government welcomes Rachel Kent's excellent investment research review published today and has accepted all recommendations made to it. We therefore welcome the FCA's commitment to start immediate engagement with the market to inform any rule changes on removing the requirement to unbundle research costs by the first half of next year. This will ensure we're better able to fund quality research into the new Silicon Valley sectors. Last week, we abolished protectionist rules inherited from our time in the EU, such as the share trading obligation and double volume cap, so UK businesses can now access the best and most liquid markets anywhere in the world. And in a highly innovative step, which represents a global first, we'll establish a pioneering new intermittent trading venue that will improve private companies' access to capital markets before they publicly list. This will be up and running before the end of 2024 and put the UK at the forefront of capital market innovation. Finally, behind all those plans must sit a financial services sector ready to innovate faster, with regulators willing to support them as they do. We have one of the most robust regulatory regimes and some of the best regulators in the world. Brexit gives us the autonomy to put their skills to even better use as we seek to become leaders in the industries of the future. So I'm delighted that we have just last month passed into law the landmark Financial Services and Markets Act, which will ensure our regulators have an appropriate focus on growth and competitiveness alongside their wider responsibilities. The Act unlocks wholesale reform of our approach to regulation. And today I can announce that we're commencing repeal of almost 100 pieces of unnecessary retained EU law, further simplifying our rulebook whilst retaining our high regulatory standards. Alongside this, last month, I was delighted to sign the UK-EU Financial Services Memorandum of Understanding as we build a new relationship with our European partners. We're working closely with the Bank of England to reflect on lessons from recent events to ensure the UK has the best possible arrangements in place to improve continuity of access to deposits when a bank fails, even if it's not a systemically important one. And I want to make sure that we're at the forefront of payments technology. So I'm launching an independent review into the future of payments led by Joe Garner to help deliver the next generation of world-class retail payments, including looking at mobile payments. We're laying new legislation to give regulators the powers they need to reform rules on innovative payments and fintech services, and together with the Bank of England, we're exploring potential designs for the digital pound should we decide to introduce it. My Lord Mayor, Governor, ladies and gentlemen, pension industry and listings reforms backed by smart regulation to unlock better returns for savers and more growth capital for businesses. That's what today's Mansion House reforms deliver. British growth driven by British financial firepower, providing higher living standards and better funded public services. With cooperation between government, regulators and business closer than ever, we'll deliver not just more competitive financial services, but a more innovative economy. More money for savers, more funding for our high-growth companies, and more investment to grow our economy. This is the vision I've set out today. Let's deliver it together. Thank you very much.
We'll bring the bottle back to you.
Pray silence for the Governor of the Bank of England, Dr. Andrew Bailey.
My Lord Mayor, Lady Mayoress, Chancellor, I think we can agree that Mansion House is the place to be tonight, but we can also sort of still live in the afterglow of Headingley as well, I think. So we'll make the... It's got to happen another 2 times as well, actually, of course, so we can enjoy those as well. I want to start by welcoming the Chancellor's announcements this evening, which are aimed very firmly at encouraging investment in the productive economy. Now, since the financial crisis, which is now 15 years ago, We've seen potential output growth fall in many economies, and the UK is included in that group. So a sustained and robust improvement of the supply side of the economy is the only means to raise productivity and thereby the standard of living in a way that lasts the test of time. So, Lord Mayor, I want to thank you for all your leadership in this work. I do just want to go back to the work that you mentioned, the sustainable finance work that we did during the COVID era, and I want to thank John Glenn, the Chief Secretary of the Treasury, because, John, you really actually provided the drive and leadership for that work, and I think much of what we're announcing tonight is, draws on and is the natural succession to that work. But as you will understand, my preoccupation is inflation. Currently at 8.7% in the latest data, consumer price inflation is unacceptably high, and it is our job, and we will do it, to bring it down to the 2% target. Now, the UK is not alone in this. There is, I can let you into the secret on, currently a popular saying among central bankers, which comes from the Danish philosopher Søren Kierkegaard. This is the only Danish philosopher you're going to get this evening. Well, from me anyway, certainly. The Lord Mayor's got some more time. So. To paraphrase it slightly, it's that life can only be understood backwards, but it must be lived forwards. And that's an important lesson as we do what is necessary to bring inflation back to target. In recent years, the UK economy has been hit by a series of external inflationary shocks. Higher goods prices in global markets owing to supply bottlenecks created by the pandemic, and then higher energy and food prices following Russia's war on Ukraine and its people. Looking ahead, UK headline inflation is set to fall markedly over the remainder of the year. This largely owes to lower energy prices, as last year's substantial increases drop out of the annual calculation. But food prices should fall too, as lower commodity prices feed through to prices in the shops. Now, while the level of economic activity hasn't grown beyond its pre-pandemic level on a sustained basis, the UK economy has shown unexpected and welcome resilience. Unemployment is at 3.8%, which is right at the bottom end of experience in modern times. And thus far, the economy has avoided a recession. Now, in many ways, this is a good thing. No one wishes to see unemployment higher or growth weaker. But the interaction of above-target headline inflation with labour market tightness and demand pressure in the economy has made underlying developments in goods and services price inflation more sticky than was previously expected. And both price and wage increases at current rates are not consistent with the inflation target. Now, in the face of these inflationary pressures, monetary policy has been tightened. Over the last 20 months, we've raised bank rate by nearly 5 percentage points. Some of that tightening is still to come through the policy pipeline, and we expect underlying inflationary pressures to recede as headline inflation falls. But the Monetary Policy Committee is monitoring developments, in particular those in the labour market, in wage growth, and in services price inflation, to assess whether pressures are proving more persistent. Now, to draw on Kierkegaard, we make our decisions drawing on the evidence we have as a guide to the future. At the last MPC meeting, that pointed to the need for further policy tightening. We're about to draw that evidence together again. It's crucial that we see the task through, meet our mandate to return inflation to its 2% target, and provide the environment of price stability in which the UK economy can thrive. And this is the best contribution monetary policy can make to the prosperity of the United Kingdom. Now, living forwards in a time of technological innovation also means that we need to secure the value of money in a different way. And for the rest of my time, I'm going to talk about the future of money. I want to start with two important foundations of safe money on which the economy depends and the public can trust. The first is called the singleness of money, while the second goes under the term finality of settlement. These two together ensure things happen that we take for granted. The first is wherever we hold our money in banknotes, in bank accounts, banknotes, coins, we can be assured that it all has the same value. I'll come back to the case which the Chancellor mentioned earlier of what happens when a bank fails in a moment. The second foundation, finality of settlement, means that, quite simply, when we pay for something, we can rest assured that it actually has been paid for. Now, I say this because there's a lot going on in the world of money, so let me set out some of the developments and where they may lead to. So let me start with those recent events, the failure of a number of banks in the US and in Switzerland, and the consequence here of our resolution of the UK subsidiary of Silicon Valley Bank. That did raise two questions over the singleness of money. As bank deposits are money, how far does that concept extend, and what steps need to be taken to ensure confidence is maintained? Now, an important qualification to what I said a few moments ago is that setting a deposit protection limit, £85,000 in this country, means that in the event of a bank failure, money held on deposit in a failed bank above that limit may not retain all its value. And as was clear in March, what happens to the money of customers who hold over that limit, and therefore the extent to which that money remains singular, is less certain and depends on how a resolution is executed. Now, the crucial question that comes out of this is that sustainable? Well, we know now that the US authorities decided in March that confidence in the singleness of money had to be preserved. And so they used something called the systemic risk exemption for a number of banks to extend depositor protection, which in reality meant taking steps to ensure that all of the funds lodged in those banks remained singular money. Now, the term systemic risk is important because the concern they had was that a breach of the singleness principle for large deposits in one bank could lead to a much wider loss of confidence in others. Now, in the UK, we were able to resolve the subsidiary of Silicon Valley Bank without having to put that principle of singleness to the test. But the lessons were nonetheless clear. We must, when designing and implementing resolution strategies, avoid any uncertainty over what will happen. We must have clear ground rules on the principle of singleness in the event of a bank failure. And so, as the Chancellor mentioned, it should be no surprise that, as authorities, we're thinking carefully about this issue. It doesn't automatically mean all money is guaranteed, but we must ensure the rules are up to date and clear. And its developments in technology, both our ability to make payments digitally and quickly without queuing at a branch, and the speedier transmission of information about the perceived health of financial institutions that have brought this issue into very sharp relief. Now, that's just one example of how technological changes can bring new risks and, of course, new opportunities. So let me move briefly on to crypto assets. These can take two forms currently. One is unbacked crypto, the other is so-called stablecoins. I'm going to repeat something I've said a lot of times. The former have no intrinsic value. They're highly volatile and best treated as extremely speculative investments. The latter, so-called stablecoins today, are used as settlement assets for transactions in the crypto world. But as currently organized, they're not robust, and they don't meet the standards we expect of safe money in the financial system. And they both fail the two basic tests of singleness and settlement finality. So they're not money in that sense. Now, much more promising in my view is the prospect of enhanced forms of digital money, which satisfy these two tests. And this is perfectly possible and perfectly achievable. Now, let me start with the question, what is enhanced digital money? So I use the word enhanced deliberately because today we have money that's held entirely in IT systems. So we have things that are digital. So I define enhanced digital as where we have the capability to do a lot more with it, to attach a lot more executable actions, to set things, smart contracts up with it, some of which might be quite simple, some of which might not be. But the key point in all of that is that we preserve the singleness of money, but expand the utility of money. And that's a great opportunity that we have in front of us, as I'll come on to. So the next question I want to ask is, are we just talking here about central bank digital money? Well, as central banks, we do already provide digital money to the financial system at the wholesale level. But it is not uniquely true that digital money must come from central banks. There's no reason to think that that should be the case, in my view. It's not the sole preserve of central banks. A third question is there a future for this stuff? Now, I think the precise answer to that is we don't know, because we never know the answer to the question precisely for new innovations. That's the whole point about innovating. I would wager to say that more likely than not, the answer is yes, there is a future for digital money, and that we must avoid what I call a failure of imagination. Inability to specify a very precise, detailed use case today is not a good reason to think there won't be one tomorrow. And let's face it, there are all sorts of stories around all of our skepticism that we needed something that looked like an iPhone before it existed. And actually, if you go further back, the same is true of railways. Turns out horses were just as good. So who might issue this new digital money, and might we see innovation which streamlines and hugely increases the productivity of important parts of the financial system? Well, I think the answer to the second question is yes, it is potentially a major innovation and one that we should encourage. So how might all of this change with new and enhanced digital money? Well, we're exploring with the Treasury the case for retail central bank digital currency. There's a task force on CBDC, which we're jointly running. And this is very important work. And we're very keen to hear views and engage widely throughout the project. We've recently concluded a public consultation which has, for us, broken the record of the number of responses, with over 50,000 responses. And I welcome that, because the Chancellor and I have always made clear that the introduction of a retail CBDC would be a major step, and that there needs to be an important public debate about the future of money in the UK. We also welcome a wide range of views expressed in those 50,000 of what should come next. Some of the responses indicate that retail CBDC can be a real breakthrough in the world of digitalisation. Others suggest concern about a desire by the authorities to reach into people's privacy, which is absolutely, I should say, at odds with what we should do and indeed would do. And I will just say that whoever painted "No to CBDC" on a motorway bridge, I can only apologise to the Cumbria Biodiversity Data Centre. I'm very sorry about this, and that we caused this to happen. But from the Bank of England's point of view, our main motivation for a retail CBDC would be to promote the singleness of money by ensuring that the public always has the option of going into fully functional central bank money that can be used in everyday life. And we've set out the arguments for why this might be needed in the consultation paper, but we don't yet know definitively whether we will need it. And that depends on how trends in money and payments play out. What I will say is that our work on retail CBDC in no way alters our commitment that physical cash will remain available to any and all that want to use it. Cash is here to stay. So let me come on to the mix of money in the future. I don't think that we should be using enhanced digitalisation materially to shift the mix of commercial bank and central bank retail money towards the latter. Commercial banks support credit creation in the economy, and I don't want to see this impaired. So we want to encourage more thinking and action in the world of enhanced digital bank deposits. So yes, I'm going to be quite blunt tonight. This is a call to action, particularly the banks. Don't leave us as central banks as the only show in town. We want to be able to have genuine choice when it comes to digital money. Now, we may also get proposals to create digital money in the form of stablecoins, new stablecoins, which could be issued by banks or non-banks. And we will shortly set out proposals for regulating these systemic stablecoins under powers contained, as the Chancellor referred to, in the new Financial Services and Markets Act. And these stablecoins will have to meet the tests of singleness of money and settlement finality. But they can do. That can be done. Now, I want to end by turning to the prospect of wholesale enhanced digital money and talk briefly about what we're doing at the bank. There is, in my view, huge scope to revolutionise the productivity of important parts of the financial system, particularly in areas like settlement and custody. Wholesale central bank money, which is accounts at the Bank of England, is an extremely flexible and versatile thing. And it's an area where, in my view, we can say with great confidence that we will want to encourage an expansion and enhancement of the use of enhanced wholesale digital money. And we want to maintain the ability for wholesale financial transactions to settle in central bank money, which is the safest form of money to do that in. So we recognize that should they be widely adopted, tokenized financial market transactions will require this ability too. But as many of those in the payments world have told us, we're well on the way to enabling this innovation with the renewal of the bank's real-time gross settlement system, the largest infrastructure program the bank has undertaken under the leadership of Victoria Cleland. And this puts us in a very strong position to deliver solutions which can integrate central bank digital money in RTGS with tokenized transactions. And we think this is the fastest and most efficient route to take. Last month, we migrated the wiring of RTGS with the outside world successfully. Somebody put it to me, we've moved from copper to fiber optic. And I want to thank all the firms, and many are here tonight, involved in making this a success. What it means is that we have a much improved messaging system with the ability to transmit much wider data, which starts to enable greater programming and enhance domestic and cross-border payments. And next year, we'll introduce the new settlement engine. But the ambition doesn't stop there. This will create the platform for change and enhanced digitalization. Last year, we consulted on what the industry would like to see next in terms of wholesale payment capability. And Victoria and her team are now working with industry to develop an ambitious, and I will stress, world-leading roadmap of future payment innovations that we will introduce in the UK. This is all very exciting, and it puts us on the threshold of what can be major changes. So let me finish with one thought here. What the history of the city suggests is that there is great capacity to move on from past successes and seize the opportunity to get out in front again. And we have that opportunity with the digital world. So we need to take it. Thank you. Now, I said I was finishing, but I've got one more thing to do, which is to propose a toast to the Lord Mayor and the Lady Mayoress. The Lord Mayor and the Lady Mayoress.